G'day expats and welcome to another episode of Expat Chat, episode 112 today. And as always, joined by my mate, colleague, news from Australia. Keeps me in touch with all the good things happening back down south. G'day, James.
G'day, Brett Evans. And those that are tuning in today, whether you're dialing in from your, I suppose, YouTube channel of choice, or podcast channel of choice, I should say. Brett Evans, the Managing Director for the Europe, Middle East and Africa's region, joining me from the desert. How's it going, Brett?
All well. We're setting into the year in a quick way. I can't believe it's
Oh,
March. Is it
I
tomorrow?
know.
Happy leap year for
Yeah,
today. So for those
yeah.
who celebrate had their birthdays on the 29th of February, sucks to be you, I guess,
Well,
every 4 years
I-
having a birthday.
I'm pretty, and this is the one, they say that this is the one day of the year that apparently a girl or a woman, a woman can drop a knee. But I think that's just a load of puffery, to be honest, because I think that's a very old and conservative norm.
Well, I think Camille was probably going to do that, mate, for you if you didn't pop the question the other month.
Yeah,
So for those
yeah.
folks out there, James is getting married. So ladies, he's
No.
off the market, and yeah, lovely. I haven't met her, but I feel like I know her very well.
That's it, mate. All those photos. But mate, jumping into today's episode, it's a one that's come up a few times. I've got a couple of clients that are repatriating very, very soon, and I thought, what a great topic. When is the best time to repatriate back to Australia when we consider tax, for tax purposes? Is there times in which we should repatriate and it's tax efficient, and with consideration to whatever country you're in, the
Yeah,
Australian financial year, and a lot of other things.
yeah. The answer really depends on their domicile, where they're residing, because every country has their own nuance. But mate, let's get the housekeeping out of the way. A bit of a compliance disclaimer. All the information we're going to have a chat to you guys about today will be treated as informational and educational purposes only. Please do not treat this as financial advice. If you need financial advice, speak to specialists, speak to Atlas.
Sounds good, mate. Now, jumping into it, you were spot on. It really depends on where you're coming from. When you think about timing, I'm gonna, be biased towards the United States, and I guess APAC in general. But you look at their tax years, you look at the calendar years, but that's not really going to line up really that well with the Australian financial year, which is obviously from July to June. So that's actually quite a difficult one. But I mean, ultimately, you want to try and be tax efficient, so you're reducing, I guess any potential, I guess you want to reduce the ATO's ability to tax certain types of things, assets, accounts, whatever it might be, when you're returning back to Australia. And therefore, it's doing things potentially in the previous financial year, before you're coming back to Australia. I think
Yeah.
that's not putting it clearly, ladies and gentlemen. Let's be
No, no,
honest.
that's a bit of circumlocution there, a bit of velocity. But what you're virtually saying is,
Yeah,
the more time you give to a repatriation, the better results are going to be because, most countries, their tax years don't line up with the Australian tax year.
not
So,
at all.
it's not like doing something pre-1 July from an Australian point of view. It could be pre-1 January from a US point of view or pre-4th of April for the UK, or there's all those sort of considerations as well.
Yeah.
And then you have interlaced over the top of that, you know, deemed disposal on acquisition events, but
Mm,
certainly with respect
mm.
to Section 99B, if
Yep.
you do have foreign trusts, that needs to be done beforehand. So let's just, I guess we've got to give the folks an answer. So
Yeah.
let's just, we can't just say it depends. Okay, see you later, guys. Thanks very much for coming.
Flip
Yeah,
that coin.
that's right. So let's just go through and pick some of the highlights, from a country point of
Yeah.
view. Do you want to run through the US? I mean, Uncle Sam has some absolutely crazy rules over there. If you're a US-based resident, whether it's an E3, H1, green card, or citizen, when is the best time to move back to Australia?
Yeah, I mean, it's a good question. Again, it does depend. If we consider you've built up, say, retirement accounts in the US, your 401ks, 403bs, IRAs, the Roth, all the like. And let's say you're coming back at a time in which you are retiring. So let's say you're over 59 and a half or 60. When you withdraw those accounts or withdraw from those accounts, they should only be taxable in the US if you're only a US tax resident. But if you're withdrawing them and you're in Australia, and you're an Australian tax resident, well, the US still has taxing rights on those accounts, but now the ATO is going to want to see you declaring that in your Australian tax return as well. So sometimes that can result in double taxation. And the reason for that is our tax rates are different to the federal tax rates in the US. Often that's when Section 99B comes into it, when it is those kind of pension-like accounts. But consider an example of an Australian resident residing in the US withdrawing, say, their Roth account. Now, their Roth is an after-tax retirement account which grows tax-free, and then when they withdraw it, if it is a required or, I suppose, a qualified withdrawal, then they're withdrawing it, and it's also tax-free from the US aspect. But if they withdraw that and they're back in Australia, yes, it's still tax-free in the eyes of the US, but it's not tax-free in the eyes of the ATO. So that's where timing can be a really big factor. You know, withdrawing it before they arrive in Australia, ideally in the previous financial Australian year, and then coming back, that's going to be a really good outcome for that individual. And then on top of that, if they're accumulating or they've accumulated, say, assets such as probably the easiest one is probably RSUs, you know, your shares from your employer, you know, technically deemed acquisition is going to kick in when you return back to Australia. And that just means, okay, now ATO has taxing rights on that portfolio, but consider whether it might make more sense to diversify, sell down a portion in the next calendar year, next US tax year, and then bring back the proceeds, recontribute it to your super, pay off debt, put it in maybe even an investment account in Australia. There's a lot you can do with that, but that's some of the main things to give our listeners a bit of an example where timing can matter.
Definitely. And I think it's a cracking one. And we'll now jump across halfway around the world to the Middle East, where there's this misnomer that, you know, bunk up into the UAE, there's no tax and all that sort of stuff. And then, look, technically it's right. But on that repatriation side, it can be very different, especially now with the UAE marching from end of service benefits into a super-like scheme called DEWS, DEWS. So the way that works is the employer will contribute 5.83% of your salary towards your end of service benefit equivalent. But where it's different from end of service benefits is that it's actually put into a trust. Probably Zurich, more likely, is going to be the administrator. And then you can go and select your investment style along the lines of what you do with your super accounts. Now, why end of service benefits haven't been taxed in the past when you repatriate to Australia is because it's an accrual of your income that you've earned while you're a non-resident. So you're sort of asking, why does it make the DEWS things different? And the reason being, as James sort of touched on briefly before, we have this rule in Australia called Section 99B, which is the taxing of foreign trusts. And essentially the way it works is you will pay capital gains tax on any gains that you've realised in the same financial year of you being in Australia. So let's run through someone who is looking to move back to Australia on the 30th of August, and they've had a DEWS account for the last 5 years that has built up and accumulated in growth. And come July, you're preparing for that move back to Oz. You relieve your employer, your cash account in your DEWS account gets cashed out, and then you move back to Australia. And then a couple of years later, you get stung with a tax from the ATO saying you've crystallised a capital gain on that DEWS account. And you say, well, but I've been non-resident for 5 years. But because you did it in the year that you were a tax resident, therefore you pay tax. So that gentleman or that lady in that case would have been better off cashing out their account pre-30 June. So you just, in the investment selection, instead of high growth or balance, you just hit cash, crystallize all those gains, and then for the next 3 months, you just hold it in cash until you return back to Australia. So that's a good example there, certainly from a point of view of the UAE. If we jump across a little bit further across to Europe, UK is obviously a popular rite of passage, and their tax year is an April to April tax year. They don't have things as adverse as, say, the United States, where they've got those day counts and that sort of stuff. But, when we talk about, say, ISA accounts, it's a good example. So ISA accounts are very popular in the UK. People can obviously invest in a tax advantageous way, capped up to £20,000, I think it is, per account. And from there, you wonder, do I repatriate that money back to Australia? Do I not? As James said, you're deemed to have acquired those assets as of that date of return. And ISA accounts from a non-resident's point of view, from a HMRC point of view, doesn't get the tax favouring. So suddenly on that date of return, let's talk about the 1st of August again with that husband or that wife, you're deemed to have acquired that ISA account on the 1st of August, and you've lost all the tax benefits with HMRC as of 3/30 August anyway. So people often get quite caught up in debate in terms of, oh, you must return to Australia on the 1st of July or don't return before 30th of June. It's not really the case. US is probably the prickliest one when it comes to that repatriation side. Yeah. Everywhere else, you can return almost whenever you want, because you are deemed to have stopped working and stopped being a non-resident on that day before your day of return to Australia. So, I heard one the other day that someone said, oh, I'm going to return on the 1st of May. No, I've changed my tickets to the 1st of July. I said, why is that? And they said, because I was worried that because I'm an Australian tax resident in that financial year, they're going to tax me on everything for the last 10 months.
And I said, no. Wage income and everything. Yeah.
Exactly. I said, no. I said, you'll just pay tax on that May and June period that you're working back in Australia as an Australian tax resident. So don't tie yourself in knots. But I think it's more a case of managing your assets in that repatriation is a massive part, because that deemed acquisition, we're still getting people asking us about hiding money in all sorts of little fruity and frisky locations. And it's just like, when the BVI, Panama, Liechtenstein, Luxembourg, everyone is a signatory to the CRS, except the United States, I should say. There is no place to hide at all. Yeah. People will notice now Australian banks are asking for your foreign TINs, your tax identification number, and the reverse is happening overseas as well. As soon as they see an Australian passport, they want to know your Australian tax file number. That's your tag. Then they know, okay, James is an Australian citizen. He's living in overseas. Therefore, I'm going to pass all his financial data to the ATO via the central banks. Simple as that.
Oh yeah, they're really onto it. Especially the big banks back in Australia, in terms of they know, data does take a bit of time, but they know when you've moved overseas, and usually that's when they'll, deem you to be a non-resident sometimes, or a foreign resident on your accounts. What's interesting about that is, if you're telling the bank that you're a non-resident, but you don't give them a TIN or the correct reason, rather than applying that 10% withholding tax on the interest income, which is normal, that's normal. That's not a, then the tax rate goes up to 45%. So the highest tax rate that we have, and that's actually a regulatory requirement. That's legislation. The banks actually legally have to withhold 45%, not the Medicare levy, on your interest that you earn. You will get that refunded to you when you lodge the tax return, but that's when you're not communicating the right things to, I suppose, the banks. I've seen that happen quite a few times with, I suppose, those nomad types, where they don't want to be a resident of Australia, but they technically don't have a home anywhere else. And it's like, oh, well, they can't give a TIN, a tax identification number, but they also can't complete that form correctly because they don't have another residence or domicile. You're really running a big risk there.
Yeah, exactly. I mean, there's a price of admission when it comes to, that sort of lifestyle. You want a carefree lifestyle, great. But with that carefree lifestyle comes all the baggage of compliance. And doesn't matter where you go. You can be in Kazakhstan, in Timbuktu, doesn't matter. You have to, compliance has gone from being a nice thing to now, being a very important thing. So I think we wrap it up there. I think in summary, to me, in terms of when is a good time to return to Australia, it doesn't necessarily matter when you go. It's more so your assets. That's the biggest thing I think you need to sort of take away from that. And it comes back to the 5 Ps. Prior preparation prevents piss poor performance. And if you reverse engineer things backwards, say from 1 year out, and look at how the taxes interlace and overlay each other in that coming period of time, you will find sweet spots and you will find black spots. Stay away from the black spots, go for the sweet spots, and then to start to transition to that process. The other good thing about preparing for repatriation is in that preparation and repatriation of assets, it will almost force you to dollar cost average as you start moving things back to Oz in the lead up to that point. So it just means managing your currency risk. Murphy's Law guarantees that on the day of departure, if all your assets are held in your home country, the currency will tank, and it won't be a good experience for you. So, reverse engineer it, guys. Work backwards 12 months. 18 months sometimes, and then
Yep.
just go through and look at those optimal times to be able to blend it through, and you should get a good result.
Absolutely, mate. Plan ahead and plan early.
Yep, I love it. So, right, guys, I won't do any housekeeping today. You know the rules. Like, subscribe, share, rate, and we'll be in touch in the next week.
Sounds good. Thanks for tuning in, guys. Thanks for another episode.
Thanks, guys. Take care.